All right, we're on to lesson one, cash flow versus appreciation. When you're getting started, you need to decide if your main goal is going to be maximizing cash flow or maximizing appreciation. If cash flow is your main goal, I would shoot to around $300 to $400 a month in cash flow per door. And I'm talking after all expenses. So that's going to be your mortgage, taxes, insurance, potential utility costs depending on the property type and the area. And then there's also going to be potentially management costs. And if you're getting started right in the beginning, I would recommend to always self manage your properties if possible. Even if you're out of state, there's ways to do this where you can contract out different repairs and things like that. But you're going to learn a lot more doing it that way than if you were paying somebody else to do it. And also, you got to think about it this way: this is one of your main assets, so you really need to take good care of it. And some of these third party management companies, they're just not going to care as much. So, my main strategy is buying properties in central Illinois. This is a very stable market in terms of prices going up and down. If I lived in another market with more population growth, I'd probably focus more on appreciation. So, it really just is going to depend on what market you're in, where are you an expert at, and maybe where do you have some connections at, even if you're out of state. Using those local connections can make a big difference. So my first 10 rental units, it took me a while to get up to 10 rental units, but that was my main goal to get to that amount, at least getting started. And that gave me around 4,000 a month in cash flow. So that's about $400 a door or about $48,000 a year in income that these properties would give me. And I'm focusing on more of a low cost of living area, such as the Midwest, Rust Belt states. That's just where I'm an expert at. That's where I live. So that's how I happen to invest in Central Illinois. For beginners, I find it easier to start with cash flowing 1 to 4 unit properties in these lower cost of living areas. It's just a lot easier entry point. You'll get more reps and experience quickly versus just saving up a lot of money over several years and buying one big expensive property. You can read a lot in books or even in this course, but after you get started and start investing and maybe you lose a little bit of money, that's where the real college education begins. So let's focus on appreciation right now. In most cases, the highest returns in real estate are actually going to come from appreciation. If you're starting out with limited capital, it's harder to get started and scale your investments if appreciation is your main goal compared to cash flowing properties. The best markets for appreciation, like I said, is where the growth in population and jobs are going. Some of the best appreciating markets over the last few years have been states like Florida, Arizona, Nevada, Utah, Colorado, Tennessee, Georgia, North and South Carolina. So you're seeing out west and down south where a lot of people are wanting to move. Well, that's where home prices are going up. And those properties, they're not going to cash flow as well if you're looking to buy them, but you can make a lot of money on appreciation if the trend keeps going that way. So there's different types of appreciation actually. There's forced appreciation. That's my favorite one. That's when you buy a property that's distressed and you're just bringing it up to the median price of the neighborhood. So you can do this without really needing to hope for the market to go up a certain amount. So you're just forcing it by making it a nicer home, making it what the home prices already are on average. So that's one you don't really need to worry about a crystal ball in the future going your way. As long as things stay the same, you can make money with that method. But there's also market based appreciation. For you to get market based appreciation, you need demand to increase faster than supply. This can happen when people and jobs are moving to the area and they're not building more homes. They can only build so many homes so fast. Another way this can happen is in a low interest rate environment. So if you look back to 2021, times where interest rates were 2-3%, well, that just naturally drove money into the economy. The government was printing more money actually. So that led to a lot more demand on these houses when supply wasn't necessarily increasing. So real estate is an excellent hedge against inflation. Unless you're in a market with a declining population or job opportunities, you don't have a lot of risk there when it comes to inflation. Usually, inflation is going to lead to higher prices. If your main goal is appreciation, try to find the area where everyone wants to live or move to. There's a lot of gentrification going on in those areas, new business. That's a good sign of an area that's probably going to have some strong appreciation over time.